with the latest on the corporate front, all the market trends, expert opinion, and sound business advice. It is your unique window into the business world, direct from the heart of China.
Hello and welcome to Biz Today. I'm Zhao Yang in Beijing. Coming up, we will have half an hour of business news and analysis. On today's show, China opposes U.S. tariff hikes on EVs, chips, and other tech. And we will also take a look at the current state of the global economy. And now let's begin with our top story. U.S. President Joe Biden has announced the high tariffs on Chinese goods. The increases apply to about $18 billion of imports, including electric vehicles, semiconductors, and solar panels. The White House said tariffs on EVs will increase to 100% and 50% on semiconductors and solar panels. China says the U.S. decision to impose additional tariffs on Chinese imports is politicizing trade and economic issues. China's foreign ministry says the U.S. protectionism will increase costs and further damage the global industrial and supply chains. So for more on this, join us on the line now, Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China, and also Yan Liang, Professor of Economics, Willamette University. So Yan, first I will start with you. Could you take us through the details of the U.S. tariff hikes and the main reasons behind the White House move?
Right. So the tariff hikes focus on a relatively narrow list of products, and they're mostly the green products like EVs. As you mentioned, the tariff rate is going to jump from the current 27.5% to 102.5%. There are also, for the lithium-ion EV batteries, that would also go up from the current 7.5% to 25%. There are also EV battery parts and also some the steel and aluminum and other critical minerals, as well as solar cells, semiconductors. Solar cells, tariffs would go up from 25% to 50%, and semiconductor would be 50%. And so this will be the first round of increase in these, tariffs. And then they're also planning on the second round that would take place in 2026. Again, that would increase even more in some of the other products like natural graphite and permanent magnets and so on and so forth. So I think, this is the election year. So we understand, a lot of these are basically politicized, as you mentioned earlier. This idea that we wanted to protect the U.S. industries, especially in these EV and battery industries that are very important for green transition. And the U.S., sort of concerned that the Chinese products are going to, in a way, sort of flood the market and drive out all the competitors from the U.S.'s home markets. So that's the reason that Biden is imposing, the very, skyrocketing sort of tariffs rates on some of these products, selected products. Again, I think it's very much for the political driven motives to say we're going to protect jobs, especially in swing states like Michigan and Pennsylvania, the idea that we want to save the industrial jobs and our domestic industries.
And so, Professor Qu, some say the Biden administration's new tariff on the Chinese EVs and other strategic sectors aim to protect the future of the U.S. manufacturing. But will they achieve the goal by doing so?
No, I think Professor Yan had just mentioned it's basically a political issue. It's purely, American politics before the grand election happening. Look, I think Biden right now are doing very opposite issues doing the very opposite things that he promised to, make a greener America or to, honor their commitment towards the carbon emission commitment in the whole world. And also talking about this tariffs, the 301 investigation and the tariff is also one of the proposal by the MAGA movement. You see, the 5 workers union actually is the number one initiators of this, advocate. But Biden corresponded to that request and answered to, this request. So which means Biden is trying to please the team of MAGA or the team of Trump as well. So I don't know. I think, politics out of this purpose, if it's, for the Democrats' game, I understand. But for the electing President Biden, he is trying to please the team of MAGA or Republicans. I think this is a total bizarre. This is actually against the normal, playbook of the politics and election in America.
And yeah, so tariffs on the semiconductors and solar panels are rising, but the real headline grabber is the 100% tariff on the EVs. But you don't see many Chinese EVs in the US, right? So what are the effects of these tariffs?
You're right. So China exported $34 billion of EV last year, but the exports to the United States is only $368 million, which is about 1% of the total Chinese EV exports. So what that means is that, there's really not much EV, Chinese-made EV, in the United States right now. So that goes back to this idea that on the surface, Biden administration says that, we impose these tariffs prevent, the Chinese EVs from flooding the US market. But of course, it has not happened and it's unlikely to happen because, there's a reason for why the EV exporters don't massively try at this point to sell their EVs in the United States because this is a big undertaking to be able to sell EVs. You need to have the entire transportation, logistics, after sales, all these infrastructure needs to be established in the United States before they actually the Chinese exporters are able to sell their EVs here. And I think, given the political and geopolitical tensions and also, with the shifting economic landscapes, I think Chinese exporters are actually more keen on selling EVs in Europe or other developing countries because that is a huge market potential. So I think, again, this is sort of politicized because there's really not much Chinese EV at the moment, and it's not going to really change much regardless of this very symbolic tariffs or not. And it's the same thing with many other products that are facing this high tariff hikes. PV batteries, again, only 0.1% of China's PV battery exports are, going to the United States, and solar panel, only about 0.03% of China's export solar panels are going to the United States. So in other words, none of these tariffs are really are going to sort of reducing China's exports to the United States. So it won't really hurt China. So that's why I think some of the commentators in China basically says this is really a punch to the air, right? It's not going to have any tangible or material sort of impact on China's economy. That said, I do think that this may push, for example, EU, pressure them a little bit more in terms of imposing tariffs, right? Because the politicians would say, look, the United States is doing that. And we also need to protect our own markets. And so we probably also need to impose very high tariffs. And going back to Professor Chu's point, I do think it is, politically driven, but it could be, yes, as he mentioned, bad politics. But I think, again, Biden is banking on this idea that this is going to, save American jobs, which is one thing that he has been bragging about, creating industrial manufacturing, high value added jobs. Also accelerate the U.S.'s green transition. So I think, he's doing in a way that basically trying to boost the Democratic, sort of their campaign promise. But at the same time, I think he's different from Trump in the sense that this is not going to be a widespread sort of tariffs. So maybe will not have too much of inflationary pressure. But the irony is, as Biden said very clearly stated, in 2021, and he was basically mocking at Trump's tariffs and say that, the Trump's tariffs is basically paid by the American consumers. And, this is not going to hurt China. But now he's doing exactly the same thing. So bad politics indeed.
Mm-hmm. And so Professor Chu, China said the U.S. has abused the Section 301 investigation and politicized the economic and trade issues. So what do you make of China's response?
Well, I think China is responding in a very correct and in a very controlled way. So China is always try to, make it a reasonable, try to make it in a legal framework to discuss with the U.S. counterpart about how we can solve this issue. And just as Professor Yang has just mentioned, they do not actually have a solid ground for this, investigation because they don't even produce it. And China, as many other competitors, for example, China's EV, China's harbor machineries, China's graphite. China has no special treatment, in this kind of products import into America. Actually, it's America's retailer or the wholesaler, after choosing from all kinds of, competitors or vendors from all over the world. Okay, they say the Chinese price, the Chinese quality, or India price, India quality, German price, German quality. So after the comparison, they find out, okay, Chinese products probably is the one who can fit into my requirement in the price, in the quality, in the specs. So that's the reason why American people and American market choose Chinese products of certain kinds. So there is no basic ground for this investigation. Just take a look at the harbor machinery. America don't even produce it. And even for the EVs, America's most heavy capacity of the EV is in China and selling to Chinese, as well as for some other issues. For example, like the solar panels. What kind of solar panel can America even produce right now? Solar City? Their capacities probably cannot even fill up the demand in American market like 1%. So the basically ground for this legal issue is not existing. So again, it's totally a political issue, and also it's punch into the air. But also there's a bright side I can say is that, China and made in China actually get a very good advertisement, because Biden is telling the world, okay, in this area, we cannot compete with Chinese products. So Chinese products is probably very good, like they used to do the things to Huawei.
Well, we're speaking with Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China, and also Yan Liang, Professor of Economics, Willamette University. And after a short break, we'll take a look at the global economy. Stay with us.
Welcome. I'm Elaf Elad, economics professor and member of the Data Science and AI Center at New York University, Shanghai. On the World Today program, you can find in-depth and impartial insight, as well as critical commentary on key trends in the Chinese economy, financial technology, business, and blockchain. To prepare for the world tomorrow, join me on World Today.
You're listening to Biz Today. I'm Zhao Yang in Beijing. The OECD has recently given its updated forecast on global economic growth, which it expects to hit 3.1% this year. The organization's Secretary General Matthias Coleman said the outlook is positive.
There are now several reasons for some continued optimism for the months and quarters ahead. Global activity is proving relatively resilient. Private sector confidence is improving, inflation has declined.
And Coleman also spoke about robust growth in Asia. While the global economy has been recovering after the COVID pandemic, there are still concerns about the impacts of ongoing regional conflicts and looming international debts. So, Professor Qu, first of all, the OECD is putting a positive spin on the outlook for the global economy. It forecasts that China's GDP growth will be 4.9% this year, up from 4.7% of its previous forecast. And the Chinese government has set a target of around 5%. So what do you make of that?
Well, I think this is already based on the number existing. Look, just by the end of the last year, a lot of people have a lot of suspicion about world economy and also Chinese economy. But I think one bright side is many countries already in Europe has already been discussing about losing up their policy on the monetary. For example, easing up the interest rate in the European Union has already happening within some countries. And also back to China, you see China is shifting gears in the economic structure. So the consumption market actually has to go beyond many people's imagination. Just to go to Chinese tourism market, the culture expanding market, or like the hospitality industries, you will see very fast growth are happening already. And also taking a look at the Chinese export in the high-tech products has also been gaining fair share in the world market. So I think based on the solid numbers, we can say that Chinese economy can achieve the 5% GDP growth target by the end of the year. So I think OECD is doing their homework very well, and also I think their forecast for the Chinese economy is very similar to our estimation here in China as well.
And Yan, so what do you think are the momentum of China's economy this year?
Right. So when we look at the first quarter of the GDP growth rate, China grew at a very solid 5.3%. And that is very much driven, by both very strong supply side, which is the factory output has gone up by 7%, but also very robust, demand side. When we look at the retail sales, it has gone up by 5.5%. So I think all these are good signs that shows that the economy has gained more momentum when it comes to recovery and growth. And I think, there's also a lot of positive factors that are coming out for the rest of the year. We know that, for example, the large scale infrastructures, construction and spending is going to kick in, at the latest by the end of June. So the 1 year long duration bond issuance at the central government, has already been put in place. So the money has been already funneled into some of the local governments. And so, some of the infrastructure is going to kick off very soon. We know that China was able to manage the readjustment in the real estate sector. It's not going to drag down the overall economy a lot because China has made a pivot towards, technologies, towards green economy, which added $1.6 trillion to the GDP last year. So I think this important structural transformation is going to help to propel China's continuous sustainable growth down the road.
And let's take a look at the situation in the United States. The OECD figure tells us that the U.S. economy is resilient. The country is expecting the growth of 2.6%. So what is your response to that number, given the inflation continues to be a problem in the U.S.?
I think the 2.6% of growth rate is probably reasonable, given the current trajectory of the U.S. economy. Although I would say the first quarter GDP growth rate was only 1.6%, and so that is, quite below that 2.6% of forecast. That said, we know that, typically in an election year, there will be all kinds of policies, especially fiscal stimulus, that we keep going to drive up the economy. So it's unlikely, the economy is going to slow down significantly. And you mentioned CPI. Actually, the latest number, the core CPI rose only by 0.3% in April, month to month. So that is the lowest increase in 3 years. So that gives some sort of hope, right, that the inflation rate could continue to go down and to hit that 2% of target. That said, I think the Fed's officials are still argue that interest rate should be kept higher for longer, and others also argue that there's still room for inflation to fall, especially when they look at, for example, wage growth. There is still the concern, that the wage growth is going to gain too much of momentum, and that's it's going to drive up inflation even more. But I think, giving all these positive outlook, and again, largely because of fiscal support, with 3 very important spending bills under Biden's administration, and also with, the high interest rate. Ironically, the government has paid out a lot of interest income to the private sector, right? So over $600 billion, with a fiscal deficit to GDP ratio somewhere between 5 to 7%, that's an important stimulus to the economy. But that said, I think, there are definitely headwinds. So one thing, like you said, CPI is still not the level where the Fed likes it to be. So they're likely to keep the interest rate higher. And that could take a toll on long-term investment. And when you look at the household sector, for example, household debt has gone up to $17.7 billion. And that's over $184 billion increase from the last quarter of 2023. That's 1.1% increase. So to put the long story short, I think the households are struggling. One thing is, they're still looking at relatively, high prices, because even inflation rate goes down, it still means the prices are going up, right? It's just at a slower rate. So it's still difficult for households to, put food on the table, to pay their mortgages, to pay their car loans, because the interest cost is so high. So when we look at, the households, the Federal Reserves actually put up a research that said there are some concerns that the households are maxing out their credit and therefore behind on their payments. And the high credit card utilization rate right now is correlated with future delinquencies. And so all this is just to say, also corroborate with the data that in April, basically the retail sales remain flat in the US. And as we know how important consumer spending is for the US economy. So if the consumers slow down, I think that could be potentially, problematic for the economy.
Mm-hmm. So, Professor Xu, so some say the Federal Reserve may have no real incentive to lower the interest rates. However, there are concerns about the stagflation and the U.S. national debt reaching $34 trillion US. So, what are your thoughts on the Federal Reserve policies and how the rest of the world would be impacted?
Well, for the Federal Reserve, their target is actually very, very clear. I think number one is employment. And second is the stability in the price level. Actually, after many years of the involvement and also the reform, the number one priority for Federal Reserve is, employment. Actually, in their coefficient, in their formula, employment actually weighs twice heavier than the stability in the price. But now, since the price level, which is inflation, is going too high, so they have to balance two factors. But anyway, other things is out of the consideration of the Fed. So they want to have full employment for sure. Right now, it looks like they're doing so. But also, they have to, after they achieve the number one target of employment, and secondly, they have to bring down the inflation and to maintain the stability in the price level. Now they failed to do so, especially they find out even though the trends for the price level or inflation are looking like going down in the beginning of the year. But recently, these back and forth and the bounce and downs are showing that inflation can be really, really stubborn. So for the Fed, right now they've been working on the rope. On one hand, if they want to bring down the inflation, and which also by the playbook and a textbook, they have to do so right now. They need to maintain the high interest rate for sure. But also, as just Professor Yang has mentioned, the household debt is going up. And basically, the employment, market are showing some weakness already, even not overall, but still some sign has already been showed up in this market. So they need to bring down the interest rate to make sure the job is not going to be lost very quickly. So how can they do so? Right now, they don't even know how to do that themselves because they cannot foresee by the middle of the year or by the end of the year how the inflation can go. Especially, you see Biden has put on another round of the tariff on Chinese product. Do you know what kind of a result that would be? That would means in America, certain part of the products will go up. For example, like the injection syringes and also masks and also some other parts like the harbor machineries will go up price will go up 25% or even 50%. And that's going to put a toll on American consumer as well. So things is going to be more expensive because of the tariff. And that's bad for controlling the inflation. So it will give harder time to Federal Reserve's monetary policy. So I don't think it's going to be a very easy job, and Fed is going to make a very, very tough decision in the future.
So actually the OECD report also says the EU and Britain are significantly lagging behind the China and the US, and it expects the Eurozone economy to expand by 1.5% in 2025, with Britain was only at 0.4%. So why are the numbers for Eurozone so low?
Right. So I think their forecast for Eurozone's growth in 2024 is 0.7%. And like you said, for 2025, it's 1.5%. And UK is 0.4% in 2024 and 1% in 2025. So you're absolutely right. And I think OECD, the forecast is reasonable, that these areas would lag behind definitely the United States and definitely, the rest of the world. So I think one of the reasons is, again, there are some temporary or some structural, there's some sort of the temporary or cyclical sort of factors, right? So these countries were hard hit because of the energy crisis as a result of the Russian-Ukraine conflict, and they're still bearing the brunt, especially for some of the, driving economies in the Eurozone like Germany. Their growth forecast for this year is only 0.2%. So when you have a really leading country in the Eurozone that is growing at such a slow speed, then it's very difficult to boost the rest. And of course, Germany, because they're over-reliant on the Russian oil and gas. And so that is one of the reasons that, once that cheap energy and reliable energy is gone, it definitely hits hard on the economy. And that could also have long-term consequences when it comes to, for example, energy-intensive sectors were moved out, and that could lead to, some forms of deindustrialization. So there's some short-term, I would say relatively short-term impacts. But there are also structural problems, which has to do with the lack of investments in terms of their infrastructure, but also in terms of manufacturing capacity and upgrade. And I think for UK, they also face the specific problems of Brexit, right? Since 2016, they voted for Brexit, and that really blowed up their exports. Their export have fallen last year. And so I think all of these would drag down on the economy. And last but not the least, I think they also made many policy missteps. So for EU, they have kept their interest rate high, the policy rate high, and yet their countries are pretty much have some self-imposed sort of fiscal discipline, quote unquote. So they're not like the United States that are using the fiscal support to drive up their economy. For Eurozone and also for UK, they are trying to cut their fiscal budgets, and at the same time, they are suffering from the high interest rates. So I think, that's why I think the economy stagnates, due to all these various reasons.
Mm. Well, we're speaking with Yan Liang, Professor of Economics, Willamette University, and also Professor Qu Qiang, Fellow of Belt and Road Research Center at Minzu University of China. And that's all the time we have for this edition of Biz Today. I'm Zhao Yang in Beijing. Thank you so much for listening.